On the biggest stage in the world, FanDuel is changing the game because sometimes your player gets subbed off and your bet goes with them. Not anymore. With FanDuel Super Sub, if your player's subbed out, your bet stays in. That's right. If your player leaves the match, your bet continues on with the substitute. So you're still in it until the final whistle. Visit FanDuel.com. Get started now. Let there be goals this summer on FanDuel.
21 plus select states for Kansas in affiliation with Kansas Star Casino. 18 plus DCKYWY. Gambling problem? Call 1-800-GAMBLER. 1-800-MY-RESET. 888-789-7777. Visit ccpg.org/chat. Connecticut. Visit mdgamblinghelp.org. Maryland. Visit gamblinghelplinema.org. Call 800-327-5050. Massachusetts. Call 877-8-HOPE-NY. Text HOPE-NY in New York. Call 877-770-7867. Louisiana.
Visit FanDuel.com. Get started now. Let there be goals this summer on FanDuel.
Listen, all you New Yorkers. Taxi.
Okay, man, we're looking around.
This is the 77 WABC minicast.
You know, it's very interesting. We had some inflation reports out this week, the CPI and the PPI. And on the surface, the headline numbers were not good. In fact, they were downright ugly. But if you look under the hood, they weren't all that bad. Meanwhile, some open market prices, okay, if you're a price rule guy and you look at commodities, oil prices coming way down, gold prices coming way down, silver prices coming way down. I don't know, that's an interesting futuristic signal. And the question now is, what is the Fed going to do? The Fed meets Tuesday and Wednesday. Kevin Warsh, the new Fed head, will be his first press conference. I guess he's going to have a press conference. Maybe he won't. We don't know that yet. But hopefully he will move the Fed's model away. Growth does not cause inflation. Hopefully. He said that during his confirmation hearings. And I'd like to see him say that again. So let's talk about all these different strains. We have John Carney, Breitbart News editor for economics and finance and co-author of the daily Breitbart Business Digest, which is a must-read. And Michael Faulkender, who is the economics guru at the America First Policy Institute, former deputy secretary of the Treasury. So, fellas, I'm going to start with John Carney. All right, I know that the CPI, PPI look bad. There were some pockets. I mean, as you noted, drug prices actually coming down, which is very, very interesting. Maybe you'll talk to that. But I want to start with oil's down a lot. All right, now, I guess this is wartime speculation. This also could be, I call it Trump's secret sauce. They're actually letting ships through quite a bit. And by my count, there could be as much as 9 million barrels a day coming through last month and this month, which would have closed the 20 million barrel a day gap from closing down the Strait of Hormuz, the shortfall. But gold prices are down a lot, about $1,200. Silver prices down even more. Now, in the old days, going way back, gold and silver used to be inflation indicators. Maybe they still are. Or maybe the world's not coming to an end or something. John Carney, what do you make of it?
You're right, Larry. Gold prices just last week dropped 5.7%.
Yeah.
That's a significant decrease, and I do think it is still a predictor of future inflation. And if you looked at the CPI numbers, the year-over-year numbers were bad. But the month-to-month numbers actually showed inflation slowed pretty dramatically. Core inflation, actually, the pace dropped by half. So in April, we went up 0.4%, and in May, it was just 0.2%, and core goods actually deflated. So we actually have deflation beneath these numbers. The year-over-year numbers look ugly because we're having a couple more higher months of inflation in the 12-month cycle. But if you're looking to anything that looks forward, and I think gold, I think the median CPI calculated by the Cleveland Fed, these are more forward-looking. They tell you what's coming, and they're actually telling us that inflation is not very bad, and even more reassuringly that it hasn't spread from energy. We saw airfare go up, but apart from things, super tied to energy, we're not really seeing inflation broadening out in any way, and that's very reassuring.
Bond rates too, John. Interest rates, they're just sort of bouncing around in a range, okay? And if you had a legitimate embedded inflation problem, the 10-year would be at 5% or 5.25% or 5.5%, but it's not. It's actually somewhat less than 4.5%. So I'm not seeing any, in other words, the market price indicators, what we used to call the market price indicators, commodities and interest rates and the yield curve, none of that stuff's really moving much.
The only commodity that really actually went up a lot last week is actually a very bullish sign for the economy, copper.
Yes.
Right. It went up almost 2%. That's actually a predictor of growth in the future. It's not a predictor of inflation. So if you combine these, what I see is we're getting non-inflationary growth. And I do hope that when Kevin Warsh, I'm told he will have a press conference. And so, but I hope he uses that to actually announce a new paradigm, as you said, that growth, that we're not going to look at growth as inflationary, that we are going to look at inflation as a problem, yes, but not fear growth as something that we need to avoid because it could cause inflation. So,
Mike Faulkender, put yourself in Kevin's shoes. You could have been a Fed chairman. You were Deputy Treasury Secretary. Who knows? What do you think he's going to do? What should he do?
I think what he ought to do is not comment about the future path of interest rates, because I actually think that could bring the board together. If you look at why a number of the regional Fed presidents voted against the statement last time, they didn't vote against the interest rate policy. They voted against the statement having a forward-looking perspective about future rate cuts versus future rate hikes. Kevin has said he's going to come in and not do forward guidance because forward guidance takes you away from being data dependent. If things all of a sudden change, you have to be able to move. And if you've locked yourself in through past forward guidance, that creates a problem for you. So let's take him at his word. He's going to end forward guidance. It's going to be a much stripped down statement that just talks about where the economy currently is and where interest rates currently are. And I actually think that's the way to bring the board together and set a tone that there's a new approach to monetary policy.
So you think he won't talk about models, theoretical stuff. He'll just stick to the economy?
I think that in his press conference, when asked questions, he should reiterate that he's going to take another look at the models and bring some diversity of modeling to the Fed, because it's become too much of an echo chamber entirely built around Keynesian models, and that he wants to bring diversity of perspective into the Fed econ staff, but that the board is going to focus on the current interest rate environment and spend a lot less time opining on where the future path of interest rates might go, particularly when the biggest driver of uncertainty out there is the resolution of the Iran war, over which monetary policy has no impact.
You're kidding. I thought the Fed could influence the war.
Well, there you go. See, if as long as you recognize that the Fed has no role in foreign policy, then why are we thinking about deploying monetary policy tools to have in some kind of impact on what is the natural outcome of this foreign policy action?
Next thing
to which they have no view.
Next thing you're going to say is the Fed can print money and they can print oil. Oh, wait a second. They can't really print oil, can they?
Last time I checked, the Fed's balance sheet does not have any oil in it.
No, okay. It's the only thing they don't have. They have everything else in there. John, were you going to say something on that?
Yeah, I think Kevin is not going to put in a dot. So we're going to have the SET come out, and I think we're going to find that he wants to move away from this this is one of the key tools of forward guidance. He wants to move away from it. One of the things he could do is just say, we'll have one less dot. Maybe he doesn't ban the thing altogether, but just say, I'm not going to put in a thing, partly because, as you said, what's the point of projecting where you're going to put this, where you think the economy, where growth, where PCE inflation is going to be, when a bunch of it will depend on something you have no control over and you have no ability to predict, which is what happens in the war in Iran.
What's the interest rate story? Now, it's very interesting to me. A week ago, Friday, right? Am I right? The jobs came out, and they were very, very strong. And we've had a lot of strong numbers. Okay. Business CapEx is very, very strong as well. Durable goods are very strong. But I was interested, President Trump commenting on the jobs report said he didn't argue for lower interest rates. He argued against higher interest rates. A change. Okay, there's a change in his attitude. I thought that was very interesting. And he basically said, let Kevin Warsh do whatever he wants to do. But there's no point in raising rates just because the economy is strong. Now, I thought that was sensible, but it was interesting that he's changed. Now, you think that this is a new theme? The question is whether or not to raise rates. Christine Lagarde of the European Central Bank raised rates by 1/4 point. Now, their overnight rate is much lower than ours. I think now it's 2.25%. So we're at whatever we are, 3.5 to 3 3/4. But is that the new battle now, John Carney? Just stop from raising rates. We can't hope for lower rates?
Yeah, that's right. We're not going to get a rate cut anytime in this year, certainly, probably, unless something goes terribly wrong with the economy, which doesn't, there's no sign of that. The Fed they are going to remove the easing bias, but I don't think that's necessarily the hawkish move that the market is interpreting. I think it's actually exactly what Michael Faulkender was saying, which was we should be removing the bias altogether, right? Take this out of the statement, let the Fed say what the interest rate policy is now and communicate how they're viewing the economy, but not tell the market, oh, here's what we think we will, where we think we're going. They should make it very clear that they will respond to actual data coming in, but not necessarily indicate yes. But look, the market thinks they're going to hike. The market is building in 1 or 2 hikes this year, no cuts for the foreseeable future. I don't think the hike makes sense, in part because I think once we get through the oil shock, that when you look underneath, as I was saying in the beginning, there's actually a lot of deflation going on. So it doesn't make sense to try to cut right now.
Just
try to hike right now.
Let me follow through on that. When you say the market is now expecting 1 or 2 hikes, what are you looking at? You're looking at Fed funds futures or
I look at
the betting markets?
Futures. The Fed funds futures is typically where I look for it. You can also look at, the things like the 2-year forwards, but I really actually like the Fed funds futures market for this, and it moves around, it changes its mind, but right now it thinks that we are going to get hikes, and I don't think that's happening unless the only way that would happen is if we got a resolution to Iran, oil prices came down, but inflation kept going up. Then we need a hike. I would agree with that, actually. But I don't see that happening. I think we're going to go the opposite way. All
right, so the 10-year note is 4.48, down 5 basis points this week. I mean, you don't really see it there. And interestingly, Mike Faulkender, we're running out of time on this segment, but Mike Faulkender, the 10-year rate, this is the year-to-date, it's up 31 basis points. Okay. But most of that, 3/4 of that, is an increase in the real interest rate, not the inflation premium. The real rate has gone up 25 of the 31 basis points. So it's really like it's a growth signal, isn't it? I mean, it's higher capital returns drive up real interest rates.
Agreed. I'm a little bit concerned, though, because part of it, yes, is an increase in the expectation of growth, but the other piece is we are running unsustainable budget deficits, and the market seems to finally be figuring that out, and so they're also requiring a bit of a risk premium for that purpose. So I tell audiences all the time, I would love to see Congress decide that the way to cut mortgage rates is to get our fiscal house in order. But I don't anticipate, and I'd also like to see, and I've said this many times on your radio show, the biggest thing I think Kevin Warsh should do is go lecture Congress about the fact that he can't do it all by himself, that if Congress refuses to be fiscally responsible and put in place both tax and regulatory policy that's going to be pro-growth and low inflationary, we got to stop thinking the Fed can come in and fine-tune it all by themselves.
Let's see. I've been doing this commentating stuff one way or another on Wall Street or radio or TV for, I don't know, close to 50 years. And we've always had unsustainable budget deficits. It never changes. It's always unsustainable budget deficits. We'll never get them down. And maybe we'll talk about this on the other side. I like this idea that Warsh should scold Congress, by the way. I like that a lot. Anyway, we're talking to Mike Faulkender. We're talking to John Carney. I'm Kudlow. We're going to come back and talk about unsustainable budget deficits. Be right back. We're talking about budget deficit, the Daily Breitbart Business Digest. Mike Faulkender, has the deficit come down? We had one big, beautiful bill last year. Where is the budget deficit?
Continues to run around 6.5% of GDP, which is somewhere in like the $1.8 trillion range. And as you know, prior to the pandemic, government was spending about 20% of GDP per year. It's been averaging 23 to 24% since then. And so, as you and I have discussed on multiple occasions, we continue to have a spending problem. And, Congress has not stepped in to really do anything about it. The rescission packages, in my view, have been less than inspiring.
Yeah,
and there doesn't seem to be much desire to really address this.
What happened to those? What happened to Russell Vought, the OMB director? He was going to rescind everything. And
there have been some rescissions he's done on his own, but very little of it has actually been sent to Congress for rescission.
I know. John Carney, it's an interesting sidelight to this. I don't know that it has much economic impact. And we could argue about that till we're blue in the face. But the political impact, the accounting impact, I thought they were going to smash. Elon Musk had this great IPO, but Elon's other IPO was ignored, and that was Doge.
It's really hard for an administration to cut very much on its own. It really does need Congress. I love the idea. Look, we used to have Fed chairmen, whether it was Volcker and then Greenspan, who used to go up and tell Congress they were being irresponsible.
Yeah.
It flipped, and now we have Elizabeth Warren screaming at Fed chairmen all the time. I would love it if Kevin Warsh went up and told Congress
That's a good
they
point.
weren't doing their job.
All right, we got to jump. You're right. You guys are both right. I'd like to see that. That's a very good point. John Carney, thank you. Mike Faulkender, thanks ever so much. We'll take a break, folks. On the other side, we're going to talk to Steve Forbes and John McLaughlin.